So I'm in the mortgage industry, and this is one question that I've been asked many times throughout my career. I joined the mortgage industry in 2021, and it's 2025, and one question that has been asked always is, should I go for a fixed rate or should I go for a variable rate? And the answer to that actually changes depending on the market and the economic situation that you are in. And in this market scenario right now, I would tip towards going for a fixed rate over a variable rate. Now, I know that variable rates, a lot of people are saying that they'll come down. Inflation numbers just came in today. You are watching this video on Wednesday. Inflation numbers just came one day before. I'm shooting this video a day before it's being released. And they have come down at 1.7%, which is slightly more than what they expected, but still less than 2% that Bank of Canada needs for the interest rates, for the prime rate to, to reduce the prime rates. That basically means that variable rates should go down in the next announcement in June. But that's not the case. At least, I don't think that's so obvious, because if you look at the core inflation, if you weed out, gas prices, which have come down, which are actually increasing again now, if you weed out everything and you just look at the core inflation, that has actually come up to 3.1%. And when Bank of Canada is looking at the overnight rates and whether the rate should come down or not, they are looking at core inflation and not the inflation that is being advertised or it's been talked about in the news. So it's not that obvious that variable rates will come down, as fast as people have been anticipating. And in fact, a lot of people thought that the interest rates will actually go down in the last cycle in April, but it did not. And they actually held the interest rates. And I anticipate, given the trade war that we are in, given that if retaliatory tariffs are gone, but still things in Canada would get expensive, and with inflation, core inflation up, I think they'll still not move the interest rates. But again, that's happening in June. We are still about a month away from those announcements, and a lot can happen in that month. And that's the variability that I am talking about, where I say that I think if you're going for a mortgage right now, depending on the situation that you are in, you should be tipping towards fixed. And I'm not talking about any fixed. I'm not talking about taking a 5-year fixed. I'm talking about taking a 3-year fixed or even a 2-year fixed, so that all this variability, all this uncertainty in the market, at least in the next 2 to 3 years, that should ideally go away. Now, right now, if you compare variable versus fixed, both will be around the 4% mark. So you would have, you can go one way or the other depending on how confident you are in the economy. Right now, I'll give you some pointers as to how to decide. Now, if you're going for a home which is within the rule of 35, that basically means that your mortgage payments, your utility bill, your all home related expenses, property taxes are 35% or less than 35% of your net household income that you take home. If that's the case, so you're not hitting your eligibility, you're actually buying way below your means, then you can tip either ways, whether you go for fixed or variable. It's fine. You can go for a variable if you are slightly more bullish on the economy and the interest rates will go down. And then obviously, you have the advantage. The biggest advantage of taking a variable is that you can always move from a variable to a fixed rate anytime during the course. And that gives you a lot of flexibility and you don't have to pay any penalties. But that's not the case if you move from fixed to variable. You have to pay a penalty of breaking the mortgage. If you are maxing out on eligibility, let's say you are eligible for $800,000 mortgage and you are buying a $800,000 mortgage, a home, you are paying almost 45-50% of your income into house related expenses, then I will definitely go towards fixed. And the only reason why I say that is that you want the certainty of payment. You're already maxed out on the amount of money that's going towards the home. First of all, if you reach out to my team, they'll give you the eligibility, but they'll also tell you what you can actually afford. So the two are very different things. But that said, if you are maxing out on eligibility or buying above your means, I would recommend going for a fixed, and the certainty of fixed, because we don't know where the market is going. We can't assume that variable rates are only going to go down from here, because I think 3.5 to 4% on variable or fixed is the new normal. If you look at the last 25 years of average rates, it's at 4%, 3.8%. And that's where we are right now, or very close to that. And I think this will be the new normal for the foreseeable future. So if you're getting something around 4%, just take it and live with that certainty for the next 3 years. And then you can make a call depending on the economy that we are in. Now, one small caveat or an exception to this is, even if you're buying, above your means or at your eligibility. You can go for a variable rate if you know for sure that you will be moving out of the home in the next little while, less than 3 years. If you are going to upgrade the home in the next 3 years, now again, you're running with an assumption that your home will be worth a lot more than what it is right now. We can't make that assumption right now because we don't know what's going to happen in the next 3 years. Yes, macro level, if unemployment is not as bad as it is right now, if the economy is doing well, the companies are booming, we are again in a bullish market, then of course I think the supply gap will show and the real estate will go up. But we can't assume that in a span of 3 years. But if you are someone who wants to upgrade a home or sell a home for any reason within 3 years, then I would recommend going for a variable, because the other advantage that variable has is that you pay only 3 months of interest penalty if you break a mortgage on selling a home, which is not the case with fixed. The fixed penalties can be as high as 3 to 5 times. I have seen penalties up to $50,000 by breaking a mortgage earlier than the term. And therefore, if you are someone who is looking to upgrade or sell the home in the next 3 years, then again, variable could be the way to go. But again, do not make the assumption that the home value will only go up or go up significantly for you to make a profit in the next 3 years. That would be a mistake. Now, one of the other strategies that my clients are employing, and this is not every client, it does not fit every client. It's only those clients who are not buying above their means, like I said, and they are buying way below. Rule of 35 is being followed, where they are taking a variable rate right now. And we would, if something happens in the market, let's talk about it now. So if there is another trade war that happens that actually massively blows the market out of the water, then all these institutional investors will stop investing in the equity markets and they would want to go to the safety of the bonds. Now, there's a massive if here. And when that happens, the bond prices increase and therefore the yield of the bonds decrease and therefore the fixed rates come down. Now, this usually happens when there's a massive event that happens on the equity markets. So there has to be an artificial thing, a war, a bank collapsing, all these things happening in the equity markets where all these institutional investors go to the safety of bonds and then the fixed rates actually drop. For all those clients who are on variable, they would all move to fixed rates at that point. And we'll be making calls to every single one of those clients. And then they would be able to lock in a 3.5% interest rate. Hopefully, that's the hope at least. But that is a massive if, and that's not obvious. And that's only if you are not buying to your maximum eligibility, because if that doesn't happen, you're actually stuck at a variable rate, and that can actually go up as well depending on what happens in the market. I'm not saying it will. There's a very little chance of that happening in a recession, but you never know. No one could anticipate COVID as well. I hope this video was helpful. If it was, do share it with someone who is buying a home. If you are someone who is buying a home, at least give us a chance. Book a call from the description, link in the description, and I promise you that we'll be giving you an advice which is very specific to you, and whether it's rates or it's eligibility, we just don't take numbers as is. We are not just doing numbers for you. We are actually building a long-term connection so that you are happy in the home that you move in. That's all I have for today. मिलते हैं अगली वीडियो में. तब तक के लिए bye bye.